Hello and welcome to your Glassnode Week on-chain video report for week 29. I'm your host Checkmate and we're recording this on the 20th of July 2021. So this week we're really looking at a market that has had a lot of the volatility sucked out of it in the pricing markets. Price is looking a little bit heavy, and really when we look across a lot of these metrics, it's trying to establish a framework for, are we looking at a bullish impulse, a bearish impulse? Because it is such a low volatility environment and the energy is squeezed up to such an extent, it really could go either way. So what we went through this week is looking at all the different angles, and we constructed a bullish case and a bearish case for Bitcoin so we can really assess all of the parameters and understand what the metrics look like in the current moment, understand what they may have to change when we get some volatility, what are things that we want to see, what are things we don't want to see, and also look at a comparison between shorter term and short range type indicators and some more longer term indicators like supply squeezes and overall accumulation events that can take some months to play out. So really providing a bit of a framework for making decisions around the on-chain data and displaying some of the various tools that we can use to build up these bullish and bearish cases. So what we look at is things like institutional demand and on-chain demand flows. So we look at what's going on in the Grayscale GBTC market and the Purpose ETF. We also look at what's going on in the on-chain space and activity. We look at net entities and our net entities growth, which is a metric that sometimes causes a little bit of confusion. So really just exploring what those two metrics mean. And we'll also look at some of these early signals that are starting to suggest that there may be a supply squeeze going on, what the accumulation behavior looks like, and just understanding what those supply dynamics look like over time. So let's jump into Glassnode Studio and we'll get started with our analysis. So here we are in Glassnode Studio. We're looking at our week 29 dashboard. So price has traded between about 31,000 and 34,000 this week. We can see here that we've got a few red bars in the last couple of days. It's starting to look a little bit heavy and it's really testing that bottom floor of that $30,000 range. So to really set the stage and start this analysis, we're going to look at our URPD, or our UTXO realized price distribution. So for those who are familiar with technical analysis, there's quite often a tool that we use called the volume profile, which basically looks at all of the trading volume that's occurred within certain price bands. And we can see that that's the aggregate cost basis for all of the traders on that particular exchange. Now, what we're essentially looking at with this metric is the equivalent, but using on-chain volume. So when coins are sent on the Bitcoin network, we revalue them, or we reprice them within that current price zone. So what we're looking at here is a cluster, a fairly substantial cluster, in fact, of all of the Bitcoins that have been moved with it between about 30,000 and 34,300. So if we look at this particular volume cluster, this is actually one of the largest volume clusters in Bitcoin's history. It's now surpassed the size what we had up here in this $1 trillion range, in the $50,000 zone. Around 10.5% of, or an equivalent volume to 10.5% of Bitcoin's total circulating supply has transacted and moved within this zone. Now, again, some of those coins will be the same coins transacting between different parties. Some of them will be coins that were accumulated up here in this $50,000 range or the $40,000 range that have been sold at a loss. We know that substantial losses have been realized over the last couple of weeks. So there's a few ways to interpret this. The first one is that there's a lot of cost basis concentration, both from back in January and February, Q1 2021, but also during this current consolidation, there's a lot of coins that have moved, and our assumption there is that people have bought and sold, and therefore there's a cost basis or a concentration of people who hold coins that have been accumulated in this range. Now, what we can also see is that there's very sparse volume all the way down to about 18,800. So really between here and last cycle's all-time high, there's not a huge degree of volume. Now, you can see that we're trading at the lower end of this range, and the way to really interpret this is two things. One, a large proportion of accumulation has gone on in this zone, so that suggests that there is a buy support here. There's not a lot of volume underneath that. And what that also means is that if we do sell off from here, and we do in fact start to close in any of these gaps, it means that overall we can already see the amount of supply that is currently transacted above that level. So overall, we're talking about 6.2 million coins, and we'll cover this more in our bearish case, but we're talking about 6.2 million coins that currently exist up and above that price level where we currently are. If we fall down to a lower range, we can see that there's actually very few coins that have a cost basis in that air gap between 18,800 and our current price. So that 6.2 million coins really captures the majority of the coins that are currently going to be or could be underwater in the event of of further downside. Now, again, that also suggests that there is buy support as a result of this large volume cluster, and we know a large portion of that will have been revalued from higher prices during the two capitulation phases and all of the realized losses that we have seen. So that really sets the stage. Let's now jump in and look at our bear case for Bitcoin, which there's two main angles here that I want to focus on. The first one is the institutional demand side of the equation, and the second one is looking more at the on-chain activity, which is showing very, very slow. It's been quiet for a number of weeks now, and really just reaffirming what's going on, that there's a low utilization of the network. So on the institutional front, a big theme of this month is going to be the GBTC unlocks. We're seeing some of the largest, which are now behind us, the largest unlocks of GBTC shares. Now, the market's been aware of these for some time, and beyond the end of July, there's far fewer GBTC unlocks. That's really getting to the phase when a large proportion of them, there was no more inflows 6 months ago. So what we've seen is this persistent discount, which is slightly recovered from the lows, about minus 21%. This week, we traded between about minus 11% and minus 15%. Now, what's going to be interesting to see is how the GBTC product reacts now that these unlocks are starting to come to a close. Do we start seeing a closing up of this overall discount? Does it start trending back towards the neutral value or closer to maybe the 2% where the fees are? So really, the response of this grayscale premium is going to give us a lot of indication of what's going on that front. We can see that our purpose ETF has really started to slow down. We actually saw the first major outflow that we've seen really since back here in May. There's been a few along the way, but this was the largest outflow. So in both the purpose ETF and the GBTC product, really what we want to see is more of that volume coming in, more of that institutional interest for these regulated products, and all the ETF to really start climbing again would show that there's still that demand and interest. And at the moment, we're not seeing that case being played out. We've also seen an uptick in the OTC balance. Now, there's going to be a balance of supply and demand and how different OTC desks manage their balance and their flows. But what we've seen really during the bullish trend of 2021 was a fairly substantial and sustained outflow from OTC desks. This is matching more buyers than sellers, so the inventory is slowly depleting. Ultimately what we would see is a resumption of this trend. We saw a slight inflow of about 1,700 coins this week. So we will see whether that is a more structural trend or if we actually start getting a continued outflow from that front. So that's the institutional demand side. We're now flipping over to look more at the overall on-chain activity and what's going on the network itself as a settlement layer. Now, we've seen very, very quiet activity. We can see here in our mean block size, this is taking a 14-day median. So this is the typical value or the middle value of how much data is in each block. Now, during a period of full blocks, which we saw through all of the bull market, what we're essentially seeing is blocks that are at capacity, fees that builds fee pressure. It's advantageous for network security, advantageous for miner revenue, and shows that people are finding use in the network. Now we can see the fairly dramatic fall off of what we're seeing here is essentially empty blocks or emptier blocks. We're seeing the total volume or the total size in bytes of data that's going into these blocks is declining quite substantially. And at the moment, it's quite common to be able to get transactions confirmed within 1 or 2 blocks at a 1 sat per byte fee rate. So really, this is showing that there's a very low level of utilization going on in the network, and it's alleviating that fee pressure, but it's also not necessarily showing that there's a demand for the network on chain. We can also see in our total transfer volume, we've got a 14-day exponential moving average on here. And you can see that we saw a slight uptick over the last couple of weeks, but really we're seeing a fairly sustained structural downtrend at the moment, which has been persistent for a number of months. And again, this is showing that the demand for volume settlement remains fairly low. We can also look at our realized loss and our realized profit metrics. Now, I've got 7-day moving medians here just to really smooth out the picture and see what's really going on. Now we can see that whilst the value is trending down, so this downtrend in both realized losses and realized profits remains, and this is symptomatic of there being just less on-chain volume, so there is less realized value across the board. We are seeing more losses being realized than our profits. We can see that our realized profits or coins that were accumulated at cheaper prices are essentially very, very dormant at the moment. And the overall amount of losses that are realized on a daily basis is roughly around 2.2 times more than the profits. So what that's telling us is a little bit about the sentiment. It's showing that the market is still absorbing this additional sell pressure from the losses, but it's also showing that the amount of volume across the board is really declining quite substantially. And generally that leads to some form of volatile move. When we see this compression of interest, generally markets don't like to sit in the same place and remain static. There tends to be this pent-up energy that slowly gets built up. So we can see that the market is absorbing those realized losses 2.2 times more. Our realized profits are essentially sitting relatively dormant, and that's an indication of sentiment. But overall, what we are seeing is people are still selling their coins at a loss, and ultimately that tells us the coins that are at a loss are the most likely to continue to come back into liquid circulation and again become that sell side pressure. So if we then use that insight and we look at our total supply and loss, this is where we pull our 6.2 million coins, or 6.3 million coins as of today. So we've got 6.3 million BTC that are currently above this price and are therefore underwater, or are currently holding an unrealized loss. Now, we noted from our URPD metric that there's not a great deal of volume. In any event where price was actually to trade down below this level, there's not a huge amount of coins that have a cost basis lower than that. So what we're really seeing, this 6.3 million coins, is essentially the total magnitude of coins. Now, again, the amount of unrealized loss or profit that these coins are going to be in will fluctuate, obviously, with price. But it's telling us the amount of volume that in the absolute worst case scenario, how much supply is out there that was accumulated higher and is therefore under some kind of stress. So it gives us an idea about what the magnitude of sell side that actually could be, again, in the most extreme scenario. And when we finally close on our number of new entities, so there's been a lot of debate and discussion around the concept of entities versus addresses, and we'll cover that a little bit more in the bull case for Bitcoin. But let's just start by defining what entities are. So with multiple addresses, a single entity, be it an exchange, a single hodler, a miner, there can be a single entity, an on-chain entity, who owns a multiple set of addresses. Now, until those addresses are connected by some form, so for example, deposits go into an exchange and they all get aggregated, that would otherwise help us classify using heuristics and algorithms and various data tools. That allows us to classify that many of those addresses belong to a single entity. Now, when we start seeing people who withdraw coins from exchanges, if they never combine those UTXOs, or there's no heuristics that necessarily link two separate addresses, there's no way to tell them, aside from them being withdrawals from an exchange, if they never interact, then it's not possible to determine them to be owned by the same entity until they're combined or there's some heuristic that suggests so. So what we're seeing here is the number of new entities. These are these new, it's similar to addresses, similar concept, but with the interpretation and the algorithms and the heuristics baked into it. So we'll see that when we're looking at addresses, we'll typically get new addresses in the order of millions to 800,000 in a single day. Here we can see that our axis is 200,000 at our peak. So it shows you the order of magnitude of how many of those addresses get compressed down into on-chain entities. There's multiple addresses to the same owner. Now, at the moment, we are seeing this declining number of new entities. So this is the absolute value of new entities coming in on chain. So what we're seeing is a net decline or a structural downtrend. We've seen a bit of an uplift over the last week, but a structural downtrend really since February or January even in the number of new entities. So that's the absolute value of new entities appearing on chain. So again, this is playing into this bearish case. So to really summarize the bear case, fairly lackluster institutional demand. We really want to see some of those metrics really pick up before we can talk about positive, positive flows on that front. And on the on-chain activity side, we're also really not seeing that mass movement of people coming in on chain. We're really not seeing the volume settlement, the blocks being full, fee pressure going up, all of these things that show the network is demonstrating serious utility. And bear in mind, a lot of these are fairly short range indicators and therefore give us a case for, in the current environment, alongside price, that's the construct of a bearish case for Bitcoin at the moment. So now let's jump onto the bull case for Bitcoin. And really the way to focus on this is a lot of these metrics tend to be more longer range indicators. So they're things that look a number of months into the future. They're trying to observe what's going on, particularly around supply dynamics, and just understanding exactly what's going on in that longer term view. Is there a potential for a supply squeeze? Maybe not today, but perhaps sometime in the future. That's really what this is trying to present. Whereas, as we just saw, these shorter range type indicators talking about within the next month, next weeks, that's really what we're focusing on with the bear case. So these tend to be a bit more longer range indicators. So we mentioned previously, we were talking about entities and the difference between entities and addresses. Now, what we have here is our sending addresses and sending entities in the green, and receiving addresses and receiving entities in the red. Now, for those who are familiar with the way that a UTXO chain like Bitcoin works, when a coin is created or a UTXO is created, let's say, for example, someone withdraws a coin from an exchange and they never interact with any other address. They just remain unspent. That has created a new address and a new entity on chain. Now, let's say that person is doing dollar cost averaging and they're creating multiple UTXOs all over the place. What happens if they then combine all of those UTXOs in a single transaction? So what that does is it reassesses and goes, these 5 addresses or these 5 UTXOs have now been combined and we can now determine that are owned by the same entity. So what that does is it's actually destroying addresses, and it's destroying what was 5 previous entities because we had no way of connecting the two. When they combine those UTXOs, it actually destroys 4 of those entities because we know that they compress into one. So that's the general concept. Now, what we're seeing here on the sending addresses and sending entities, knowing that when an entity destroys their whole balance, when they send all of their coins, for example, to an exchange, that's essentially destroying one entity. We know that that accumulator who purchased all of those coins has sent them all to an exchange. That's destroyed those entities, and they've now been combined into a single entity, which is the exchange, and we're aware of them, so they're not a new entity. So in general, sending entities or sending addresses is correlated with UTXO destruction. It's destroying entities on chain, it's destroying UTXOs. Now, conversely, receiving addresses and receiving entities is the other side of that equation. So what we're seeing when we're having a increasing number of receiving entities, let's say, for example, in a accumulation phase or in a dollar cost average type environment, we're going to be seeing lots of coins being withdrawn every month or every couple of days, and that's creating entities on chain. Now, when people exercise good on-chain privacy and on-chain UTXO management, they're not necessarily recombining those UTXOs or they're keeping them in unspent condition. So it's actually a net creation of entities. So to really sum up all of these, what we're actually seeing at the moment is an increase in the number of receiving entities, which again is reflecting that somewhat of a dollar cost averaging type scenario. So we're seeing an increase in receiving entities and a decrease in sending entities. So what this means when we then boil it down and look at our net entities growth, which is taking the difference between created entities and destroyed entities, is that what we're seeing is that we have less entities being destroyed, more entities being created, and therefore on our net entity growth, the amount of on net, how many entities are entering the system, we're actually approaching an all-time high. So the way to think about this is a relative metric. We're looking at, compared to previous periods of time, during the upswing, yes, we had more entities coming in on chain, there was more buyers and there was more retail interest, but simultaneously there were lots of people who were spending and destroying those UTXOs, destroying those entities. People were exiting the system as other people were coming on board. We then saw a plateauing of that, where it's essentially describing this match between supply and demand. And what we're actually seeing at the moment is fewer people are destroying the entities on chain, fewer people are spending their coins, fewer people are emptying their wallets, and more people are continuing to come in. So this is what we mean when we talk about net entity growth and really what that's trying to describe. So if we then look at our HODL waves, we can actually verify that notion that we have some form of a accumulation or a dollar cost averaging type environment. Now, what we really want to see in this instance is young coins, coins that have been recently moved, essentially going dormant and moving into cold storage. Now, these darker red colors and into the orange, these are our 1 day to 1 week to 1 month coins. And we can see a fairly structural downtrend in all of these coins. Now, what we can also see, let's take our top yellow band here, which is our 6 month to 12 month. If we look at all of these coins, all the way from the red up to the yellow, we can see that in general, there's they're maintaining a relatively similar level over the last couple of months, right? Through the majority of this bull market, this block has maintained a similar proportion of the realized price. Now, what we're seeing is that there's a decline in the proportion of younger coins and conversely a swelling of these older coins. So what that means is that coins are gradually maturing. They're moving from 1 day to 1 week to 1 month to 3 months to 6 months, and now they're moving into that 6 to 12 month bucket. So it's actually showing this progressive migration of value getting older and older and older. So where we're getting a decline in young coins, it's being absorbed by an increase in these older coins. It's demonstrating that maturity. And this is where we start thinking, okay, there's actually a large number of these coins, particularly those accumulated somewhere between 2020 all the way through to February, and we're soon to be moving into March, where we'll start seeing this this transition across that 6 month boundary, 3 month boundary. What we're looking at is those coins and the volume of those coins that were actually held onto, and they actually weren't distributed. So what we're going to see over the next couple of months is, what does the actual sell side look like? Because we've seen a lot of the accumulation and the coins that remain held. And that's going to create a supply squeeze at some point in the future if that trend continues. But we also know that a large number of coins were sold from that $50,000 range down lower because we saw these enormous realized losses. So the way that this metric plays out over the next couple of months will be quite instructive. Do we continue to see this pattern where older coins keep growing and becoming a larger portion of the supply? Or are we going to see the younger coins start to swell up as people start to sell, take exit liquidity, or just generally lose confidence? So the ratio of these different hodl waves is really going to tell us a lot about the hodling behavior that's going on in the next couple of months. Now, to really support that, finally to look at that accumulation type behavior, we can actually see that on the exchange net position, so this is looking at the 30-day change in exchange balances, and likewise for miners, we're actually seeing a net outflow in exchanges for the first time since, well, really since May, where we saw this fairly substantial inflow occurring. And this is really essentially reversed course, and we've now actually moved into it. Over the last 30 days, we've seen more coins flowing out of exchanges than flowing into them. Likewise, the miners, despite the fact that they're incurring significant costs during the Great Migration, there's also a lot of miners who are currently have seen their revenues boost because their competition has dropped off the network. And what we're seeing is miners are actually returning into an accumulation phase as well. So we have both the exchanges that have moved into a net outflow over the last 30 days, and our miners are actually into net accumulation. And when we combine all of those factors together, what we're seeing is our illiquid supply change is continuing to trend higher. So this is really providing us quite a lot of insight into the magnitude of coins as a rate of change that are actually transitioning across that liquid to illiquid threshold. And this is a combination of time, it's a combination of heuristics. What we're looking for is accumulation style behavior. And based on the heuristics and the way that the market and on-chain behavior tends to perform, that's what we're seeing with this metric, is this continued uptrend in illiquid supply. Now, bear in mind that this red zone, you can see it actually reflects the inverse of our exchange net position change, which makes sense. What we're seeing here is there's always coins that are trying to go from liquid to illiquid. There's always hodlers in the system. There are people out there who are accumulating at all costs. Now, when this illiquid supply change metric goes red, what it's essentially saying is that the amount of spending that's going on from previously illiquid coins is overrunning and essentially overturning any of the coins that are transitioning from liquid to illiquid. So there's always hodling going on, but in this instance, the spending was dramatic enough that it essentially overran that, and there was just more coins coming back into circulation. We saw this on our exchange balances. We saw that miners were contributing to that as well. There was some distribution going on their front, and this is where we've now seen a reversion of that trend. So the spending has now slowed substantially, which we've also seen in the bearish case, where we have low on-chain transaction volume. That's a double-edged sword. That's showing that both we have low utilization of the network, but it also demonstrates that people who are holding profitable coins are not spending them. So it actually works in both ways. And to really sum this all up, we look at our long and short-term holder profit and loss metric. Now, what I really want to highlight with this metric is two concepts. The first is what I call peak hodl, which is at the zone. Normally it correlates with the previous cycle's all-time high. It's after a lengthy period of long-term holders in the blue accumulating supply, taking supply off the market. And essentially this is the genesis of a bullish impulse. When there's enough coins that have been removed from circulation, demand continues to increase or remain constant, and essentially it drives price higher. Now, all of those long-term holders then move into profit. So we can see that this light blue is them in loss, dark blue is them in a profit. As we approach the all-time high, by definition, all long-term holders, all holders, but we'll simplify it here, are going to be in profit. Now, what we then see is the dark blue zones start to trend lower. Now, this is distribution. These are long-term holders spending their coins and transitioning that wealth into the short-term holders who are demonstrated here in the red. So what we see is that long-term holders are all in a profit. They start liquidating their coins. Short-term holders take on that wealth as a wealth transfer. And when we get to some form of market top, we start to bottom out, and then long-term holders return back into accumulation. Now, previously, this peak hodl bullish impulse has started somewhere around 65% back in 2013, 75% back in 2016, and then through 2020, it was up at 80%. So we maintain this level of 80% total long-term holder supply. Now, this metric bottomed at 67%. Normally, it bottoms down closer to 50%. So what we're actually see at the moment is that the amount of supply that was distributed has actually started from a higher base. We've started reaccumulating. Long-term holders have started reaccumulating and holding onto their coins from a much higher base than was previously seen in at bear market bottoms and bear market top at the peak of the previous bull cycle. So we're currently at a position where it's about 75% of the supply is held by long-term holders, which is coincident with those bullish impulse zones that we've seen in previous markets just before the bull market primary impulse starts. So it's actually back up around the 2017 initiation point. And at the current rate, and depending on how much of that supply was actually hodled through the top position here as we form this topping pattern, how much of that supply is actually still held and people have just weathered the volatility, because that will tell us a lot as to whether we continue to trend up from this 75% up to the 80%, which again would start to signal that there's a potential supply squeeze on the horizon. So that's an overall summary. On the bearish case of Bitcoin, we have very, very low activity on chain. We have fairly lackluster institutional demand flows, suggesting that there's perhaps not the amount of supply demand balance that people would desire. And overall, the price chart is looking fairly grim by comparison. Now, if we then look at the bullish case of Bitcoin, what we're seeing is that despite all of that, we're actually seeing accumulation, a somewhat similar to a dollar cost averaging type environment, and continued coin maturation. And really what's going to be key to pay attention to in these longer range metrics is paying attention to what happens over the next couple of months, because that's really going to define how many of those coins were actually sold at the over the top, how many were hodled through that $50,000, $55,000 range. And if we do get price in either direction, what is the response of holders? Do they end up liquidating their coins? Do those 6.2 million coins that are currently at a loss, do they start to mobilize? That's really where these metrics are going to get very interesting, is once we get volatility in either direction. So thanks for tuning in, and I look forward to catching you in the next week. Cheers.